Most people invest in the wrong order, not because they're lazy, not because they don't care, but because nobody ever sat them down and told them the actual sequence. So they throw money at a stock they heard about and wonder why their net worth barely moves. It's not about how much you invest. It's about where the first dollar goes, the second, the third, in the right order. Get the order wrong, and you're working twice as hard for half the result. Get it right, and every dollar you earn starts doing serious work. This video is going to give you that order, step by step, no fluff, no theory, just the exact sequence that maximizes every dollar you put to work. By the end of this video, you'll have a clear, prioritized roadmap for your money. You'll know exactly where to put $1, what to tackle next, and when it finally makes sense to open that brokerage account everyone keeps talking about. And if you're new here, we do this every week. Real financial strategy, real numbers, zero noise. Like and comment on the video so that other people will see it too. Hit subscribe and turn on notifications so you don't miss what's coming. Number 1. Build a starter emergency fund, $1,000 fast. Before you invest a single dollar, you need a small financial firewall. Not the full 3 to 6 month fund, not yet. Just $1,000 sitting in a high-yield savings account, untouched. Why? Because without this, any unexpected expense, a car repair, a medical bill, a broken appliance, forces you to pull money out of investments at the worst possible time. You sell low, you pay penalties, you lose momentum. Get to $1,000 first. Everything else waits. Number 2, capture every dollar of your employer match. If your employer offers a match, this is the single highest return investment available to you, period. A 50% or 100% match on your contribution is an instant guaranteed return no stock or index fund can touch. You contribute enough to get the full match. If your employer matches up to 4% of your salary, you put in 4%, not 3%, not 2%, the full amount. Anything less is leaving free money on the table, and at this stage, that's unacceptable. If your employer offers no match, skip this step and consider the next point of action. Number 3, eliminate high-interest debt. Credit card debt at 20% is not a debt problem, it's an investment problem, because paying it off is a guaranteed 20% return. No index fund in history has consistently beaten that over the short term. List your debts by interest rate, highest first. Throw every extra dollar at the top one while making minimums on the rest. When it's gone, roll that payment down to the next one. You will be stunned at how fast this moves once you have momentum. Do not invest beyond number 2 until the high-interest debt is dead. It will cost you more than you make. Number 4, build your full emergency fund, 3 to 6 months of expenses. Now you go back and finish what you started in number 1. Calculate your actual monthly expenses, rent, food, utilities, transportation, everything. Multiply by 3 at a minimum, 6 if your income is variable or your job feels uncertain. This goes into a high-yield savings account, not the market, not a CD, liquid and accessible, because the whole point of this fund is that it's there the moment you need it, not in 3 business days after you sell something. This step feels slow. It is slow. Do it anyway. This fund is what lets you stay invested when the market drops 30% and everyone else is panic selling. Number 5, max your investment tradition. Now you're investing, and the first place to put money, after the employer match, is a tax-advantaged individual retirement account. If you're in a lower tax bracket now than you expect to be later, and most people in their 20s and 30s are, the Roth is almost always the right call. The current annual contribution limit is $7,000 if you're under 50. That's your target. Max it out before moving on. The tax-free compounding you get in here over decades is worth more than people realize until it's too late. Number 6, go back and max out your match. You already captured the employer match in number 2. Now it's time to go further. The annual contribution limit is $23,000. That's a lot. You don't have to max it out in 1 year, especially early on, but it's the direction you're building toward. Every dollar here reduces your taxable income now and grows tax-deferred until retirement. Even moving from 5% to 8% of your salary here without changing anything else can add hundreds of thousands of dollars to your retirement balance over a 30-year career. Small percentage increases have enormous long-term consequences. That's the math people miss. If you're finding this useful, subscribe right now. Every week, we break down exactly this kind of strategy, the habits and the math that actually move the needle. The subscribe button is right there. It's free. Number 7. Open a tax-advantaged brokerage account and invest the rest. You've exhausted your tax-advantaged options. Now, and only now, you open a standard brokerage account and invest whatever is left. What do you buy? For most people building towards their first $100,000, the answer is boring on purpose. A low-cost, broad market index fund, something that tracks the total market. A single fund with an expense ratio under 0.10%. You automate your contributions, you do not check it every day. You do not react to headlines. This account doesn't have the tax advantages, but it has something those accounts don't: flexibility. No penalty for early withdrawal, no age restrictions. This is your medium-term wealth-building engine. If you have access to a health savings account through a high-deductible health plan, pay attention. This is the most tax-efficient account that exists. Contributions are pre-tax, growth is tax-free, withdrawals for qualified medical expenses are tax-free. That's triple tax advantage. Most people use the medical spending account. The smarter move: contribute the maximum, invest it in index funds inside the account, pay for current medical expenses out of pocket if you can afford to. Use it in retirement for medical costs, which will be significant. Fit this between number 4 and 5 if your situation qualifies. It's worth building this habit early. Let's bring this together. Number 1, a $1,000 emergency cushion. Number 2, capture every dollar of your employer match. Number 3, kill high-interest debt. Number 4, build the full emergency fund. Number 5, max your investment tradition. Number 6, push your contributions higher. Number 7, invest the rest in a taxable brokerage account. Additionally, use a health savings account if you're eligible. That's the order. Not random, not based on what's trending, based on guaranteed returns first, tax advantages second, flexibility third. You don't need to complete every step before moving on. What you need is a clear sense of where your next dollar should go, and now you have it. Most people spend years figuring this out through trial and error. You now have the map. The only variable left is execution. If this video gave you something useful, and I think it did, share it with one person who needs to hear it. Your friend who's been putting money in a savings account earning 0.01%. Your colleague who just got their first job and has no idea where to start. This is the video they need. Like, comment, and subscribe to this channel right now. Every single week, we break down the financial strategies, the habits, and the real numbers that matter for people at real income levels. Turn on notifications. We'll see you in the next one.